Welcome back to another episode of Give Me Some Truth, Dame la Verdad. This is part 2 of a series we began last time, talking about expatriation, which can be a kind of quite popular idea among many Americans because they look at, having to file their taxes here in the U.S., and even if they don't owe them, they complain about the cost and the expense and the hassle of doing so. And so consequently, expatriation becomes something that appeals to them. What they may not realize is there are costs, expenses, complications, so on and so forth with expatriating. First of all, one thing that folks should consider is that it's the equivalent of $2,350 now, and you can also pay it in your local currency. There's just a fee that you have to do. There's additional paperwork, including an additional IRS form. I believe it's 8854. So there's just the paperwork. You have to go to a consulate as well and formally renounce. So there are hassles there. And then there are also hassles when it comes to if you become a what's called a covered expatriate, and that becomes an issue at certain points, Stan. We talked a little bit about those points last time, but just for folks who may not have listened to our Expatriation Part 1 podcast, what makes you a qualified expatriate? Or a covered expatriate, pardon.
Sure, Keith. Very briefly, the tests, and if you fail any one of the three, you're a covered expatriate. If you're a high earner with a average income tax liability of, I think it was $180,000. The exact numbers that we talked on, please go to the previous podcast. But somebody with a very high net income, so that their 5-year rolling average at the time of expatriation is above that threshold, is a covered expat. Then there's the net worth test, and that one's pretty. The high earner one adjusts with inflation. The net worth does not adjust with inflation, and the high net worth, you may find that it really isn't that high anymore. It's $2 million per individual. So if a couple owned everything jointly, 50-50, they'd each have to come under the $2 billion to expatriate. If they were both over that amount and only one of them wanted to expatriate, there might be planning and technical ways to get the one under, but not really, it would depend on the circumstances. And third, there is the compliance test. So you can't find out after years of living abroad that, I was supposed to pay taxes in the U.S. I'm a tax resident of the United States, even though I haven't lived in the United States for 2 decades. You can't just kind of come to that point and decide, instead of going through the processes of filing those delinquent returns and coming clean to the IRS, you can't just choose instead to just expatriate, right? Because you'll have failed the compliance test. And be very sure that you can expect that you are certifying that you've been compliant. You can best assure yourselves that the IRS is going to go back over those returns and make sure that that is in fact the case. So if you're caught not being compliant and you've expatriated, you're going to find out that you're a covered expatriate.
Yeah, and one thing to bear in mind that we may not have mentioned as much last time is one of the things, this is kind of a dual part process. There's the citizenship related kind of stuff going on and all of that, and there's the tax related stuff going on. And one thing to kind of bear in mind is that if you expatriate and the IRS determines that you did it for tax avoidance reasons, they can come back at you for money they will assume you owe. So
yeah, I mean, you have to come at this as look, I'm going to be more than forthcoming, and I'm going to err on the side of taxation on just about anything as you're leaving.
And so one of the ways that this covered expatriate situation ramps up and comes into account then is you're liable for what's called an exit tax. And so Stan, what if we look into the exit tax, what does that all mean? What does that do for folks? And then we may want to talk about one or two planning related items relevant to the exit tax.
Sure. So if you failed any of those tests and the exceptions that we also talked about in the last podcast, like for people that were born in another country and they've lived there, while having U.S. citizenship, may be able to get out of this covered expat tag. And people under the age of 18 and a half that were, dual nationals living outside the United States may also get to choose not to be a U.S. citizen, so to speak, by expatriating by that young age. Now we're faced with, you fail one of those tests and you're still hell-bent on expatriating. What are the financial consequences? And that essentially is an exit tax. So you'll need to take an inventory of everything that you own or have any ownership interest in, including beneficial interests in trusts and things like that.
And this could be quite complicated. Say you own a small business. You're a consultant.
Yes.
You're going to have to value that small business.
You're going to have to get an independent appraisal of the value of that interest. Yes. You're going to have to put this all together. Think of it as you are your own estate administrator and you're on the verge of death, so to speak. You're going to have to figure out what's in my estate. What do I own at this very minute? Okay. And on the date of expatriation, you will owe a tax based upon the premise that you sold every asset that you owned the day before you're expatriating, based on the fair market value on that valuation date. And what about our retirement accounts, things like that we can't sell or that aren't capital assets? You're also going to have to pay a tax on the basis that you took a complete and total lump sum distribution of those assets, including retirement accounts that may not offer a lump sum distribution, such as a defined benefit pension. You're going to look at the present value on the date before expatriation, and it's going to be a deemed distribution of that asset, which is an ordinary income
of the
asset.
lump sum.
Yes.
Similarly, they're going to treat your IRA, 401k, et cetera, as a lump sum distribution, right?
Yes.
Not over time.
Yes.
And so from a tax standpoint, it's important to note, IRAs, defined benefits, those are, as you said, ordinary income distributions. Generally, what the goal of these sorts of retirement plans are, you put them in when you're a high earner and you get a tax deduction, and then you bring them out when maybe you're earning a little less money, right?
Yes, and you bring it out in small increments so that you avoid higher marginal tax rates. Obviously, if you take a lump sum of your retirement account and you're still a high earner, it's all going to come out at maximum.
Well, and even if you're not
a
a high earner, right? You're retired, and all of a sudden it's like, oh, you got to take out $1 million from your IRA, from your 401k. Congratulations, you're now in the top marginal tax bracket.
Correct.
And you're going to get hit with that higher rate of tax.
And if and we'll get into the details of the capital gain part, but if you obviously had a deemed sale of all of your capital assets and you had a $1 million IRA, you're already in the top capital gains tax bracket, and you're going to pay the ACA charges as well. So you're going to be the 23.8 tax bracket on your deemed sales as well.
So that's an 8.8% jump there, versus if you're in a lower tax bracket. So, this 2 million threshold, on one hand, people look at it and go, oh, geez, that's a big amount. But it includes everything that you have worldwide. So IRAs, brokerage accounts, houses, shares in trusts, as you've said, shares in, you're a consultant. What is your small business worth, right?
Yes.
You have all these things. All of a sudden, you're getting bumped up, and it becomes a bigger deal, right?
Right. So, I mean, that's the broad rule. That's the way the exit tax works in broad strokes. It is much more technical than that. Okay. Let's talk about the capital gains part first. Okay. So it's not as bad as it sounds, because you have a special $725,000 capital gains exclusion. Actually, that was a couple of years ago, maybe up to 750-ish now.
Yeah,
so,
and I've been poking around on the internet, and one reason that we're not 100% sure is a lot of the data that we've seen sort of expires in 2020, and that they haven't widely distributed the information for 2021 and 22 and 23.
Yeah. So let's say that you've got your brokerage accounts, you've got your home, you might have a business interest, things like that. Okay, that exclusion that capital gains exclusion on the first $725,000 of gains is going to be helpful, right? To alleviate some of that. That $725,000 exclusion, of course, does not apply against your retirement accounts, right? Because those aren't capital assets. Okay, so also,
and just to be clear, what we mean, those aren't capital assets. It's just how they're taxed is not at the capital gains tax rate. They are taxed as they're treated like ordinary income.
Correct.
When they're distributed. So just to be clear on that point.
Right. So there's also, technically, there's an ability to defer that tax until you actually sell the properties. However, it gets very complicated. So if you're trying to avoid the complications of U.S. tax, you might actually just want to sell all of your assets and reset your basis, right, and go about your life elsewhere as a tax resident of wherever you are.
But again, that becomes dependent on where you are, right? Because if you're in, a high tax jurisdiction, even though you're paying 23.8 in the United States, you're maybe paying.
Right. You may not want to sell it if you're living in Denmark and you're in a 50% tax bracket or something. Absolutely. Which would then, by the way, that's a very interesting observation, Keith, to which I would say if you're somebody looking to expatriate because of the taxes and you live in a place that has higher tax rates than the United States, talk to us first. I mean, let's work this. Let's work the math, and we'll show you that the math would suggest that if you're going to be a covered expatriate, that you are biting off your nose to spite your face, so to speak.
Yeah, especially I would say if you're in Western Europe, because your tax rate is not going to be lower. If you're doing this, then and this gets into complicated questions, because if you pay U.S. tax on certain items, frequently you'll get a tax credit. Right. How do you claim that tax credit if on this expatriation tax?
Right.
If you're in Western Europe, generally your tax rate is going to be higher. Now, if you live in, a zero tax country or something like that, you're not going to be able to escape it. And one thing as well that I'll point out, the notion of offshoring your assets, this kind of idea of the Panama Papers.
Yes.
Or that sort of thing. If you live in one of these high tax, Western jurisdictions, with things like GATCA, which is the global equivalent of FATCA, the ability to hide assets in this way. So if you think you're going to be able to, I'm going to renounce my U.S. citizenship and I'm going to offshore my assets and not pay tax on that in whatever Western European jurisdiction I'm living in, you're not going to be as successful as I think you think.
That's right. That's right.
You're going to be.
Right. So getting back to this notion of deemed sale of your assets, you can defer the payment of the deemed sale. You can defer that capital gain until you actually dispose of the assets. It is a one-time irrevocable election to defer on a property-by-property basis. So you could say, well, okay, I'll pay the deemed sale on all of this, but in terms of my Beverly Hills home, I'm going to defer payment of the taxes, something like that, right? But if you do that, there's all kinds of special, ways that the IRS still crawls into areas of your anatomy that you may not want them to. And you may have to post a bond, and you're definitely going to have to pay interest on the taxes.
There is no such thing as a free lunch from the IRS.
So you'll be paying taxes every year until you sell the property because you'll be paying interest on the deemed sale. And let me point out that what happens if, your Beverly Hills home is worth $5 million at the time you expatriate, and then by the time you dispose of it, for whatever reason, maybe it's only worth $3 million. Well, then you're going to get proceeds of $3 million, but you're still going to owe taxes if you sold it for $5 million, and you were paying interest on that $5 million, the capital gain on the $5 million all along until you sold. So that you're carrying that risk, right? So no free lunches here with the IRS, people. Okay, let's talk about the deemed distribution. Okay, so if you have an IRA or any type of IRA, SEP IRA, simple IRA, rollover IRA, traditional IRA, you have to pay the tax at the time as if you'd distributed the IRA. That's the ordinary income tax is going to apply to that asset in whole. If you have a employer-based plan, you have the ability, like a 401k or a 403b or 457, you have the ability to elect, again, not to pay the deemed distribution and wait to pay as you withdraw. As you withdraw, you're no longer a citizen. You'll be deemed to be a non-U.S. person, right? This is life after expatriation. You're a non-U.S. person. The hitch here is that the withdrawal tax is 30% as you withdraw, right? And that is the default withholding rate.
And there are exceptions depending on which country you're in terms of tax treaty.
No, but there are no exceptions because if you expatriate, you have to agree to waive any treaty benefit. So you are going to pay, there's going to be a withholding. It's just going to automatically be withheld at source. You're going to get the net 70% on every dollar that you withdraw after expatriation.
And would you be able, you're waiving treaty claims, they're withdrawing 30% at source.
Yes.
Would you in your country of residence be able to necessarily claim a tax credit for that?
Well, I mean, it is a.
And I'm making the who knows, right?
Right. I mean, it's. I would say in most cases likely, sure. But again, I mean, if your taxes in your foreign country, are still going to apply to this IRA, and they're going to be,
401k, right? Because
I'm sorry, 401k.
An IRA wouldn't. Yeah,
I didn't mean IRA. Excuse me. You're right. If your taxes are still going to be imposed in another jurisdiction and they're sufficiently high, then maybe you don't want to go down this road in the first place, right?
Yep. Again, so I think from the bigger picture, and this is one of the things Stan and I talked about before this podcast is, when you're looking at this situation and you're looking at it as, I have to pay $500 every year to file my taxes because I pay a company to help me with all of this.
Yes.
And, it really stinks and it's a pain in the butt and I have to get this stuff together and blah, blah, blah. And it restricts what I can purchase here and so on and so forth. when you annualize that $500 versus what could be the prospective costs longer term of this, and the fact that you may not actually be, you may still be dealing with the IRS well into the future.
Yes.
The cost-benefit analysis suggests this is not a decision you should take just, boom, let's expatriate. I'm tired of filling out Form 1040, let's expatriate, especially if you have if you're a covered expatriate.
Right.
If you're not a covered expatriate, the situation changes a little bit. If you are exempt for one of these other reasons, the situation changes a little bit, but you could be a reasonable earner over the course of your life, save money, have a house, and in the country where you're residing and all of these sorts of things. And you say to yourself, well, I started working in the US, but I've been living here in X country for 25 years. I don't really have that connection. I'm tired of, paying somebody to do these tax returns for me now, especially maybe I'm retired or whatnot. Not as straightforward as you may think.
No. I mean, look, you may be a person who is going to get wiped pretty hard, going to get hit by this tax. You still want to expatriate because you feel like, okay, 5 years from now, I'm going to be in a tax haven. I'm going to be living in a country that doesn't tax my offshore wealth, or something like that, right? And for whatever reason, I may be coming into enormous inheritance. So I may have a lot of income production, or my business is going to take off, right? So we're not saying in all circumstances as a covered expat, that you don't want to go there. But one thing that I will say with some confidence is that, if you're contemplating expatriation and you fail the net worth test, meaning that you have more than $2 million, then it doesn't mean that you can't eventually expatriate. But what it does mean is that if you're really considering expatriation, you need to start working with somebody that understands this process. You would be working with the accountants and working with a financial planner, right? And thinking about, okay, first, is it possible through strategic planning to one day in the hopefully not too distant future to be not covered?
And so
to get there.
Yep. And so, perhaps here is a good stopping point, because Stan likes to leave everybody with a taste for more. What we may want to talk about is in Expatriation Part 3, what we would be looking at in terms of how you might strategize around, if you are a covered expat, getting yourself either out of the covered expat situation, or looking at
or just
the situation
exit tax mitigation.
Yep, exactly.
Right?
How to handle. So I think this is a good place to stop, and what we can think about, and we'll look at for another episode is mitigating expatriation taxes and covered expatriation and all of that fun stuff. So thanks again for listening. If you have further questions, we'd recommend you reach out to us. info@walknercondon.com. We can't always answer every question. We got one today about the visa process in a particular country. We don't know those sorts of details, but hopefully we can put you in the right direction on your queries if we can't answer them. So thanks again for listening, and look forward to sharing our insight with you again soon.
Walkner Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walkner Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Thanks for listening, and for further information, please visit wachnercondon.com.